In 1988 Tokyo, Japan, the Nikkei reached an all-time high and 8 of the world's 10 biggest companies were Japanese. Japan was leading the world and the United States was deeply concerned. At the time, Japan's GDP per capita was 10% higher than that of the US. Even the iconic Rockefeller Center in New York was under Japanese ownership. Films like Blade Runner imagined futures dominated by Japan. It felt as though the rising sun would shine forever. But things changed quickly. In 1990, the Nikkei crashed by 28%, wiping out $2 trillion in market value. Shockingly, even by 2024, Japanese wages have not returned to the highs of the economic boom years. But what went wrong after such a miracle? To understand it, we must return to the late 1940s. After surrendering in World War II, Japan was partly occupied by the United States, and its economy quickly fell into recession. The country was devastated, factories lay in ruins, much of the workforce had perished, and trade connections were severely damaged. Concerned that Japan might follow China into communism, the US stepped in with bold economic reforms. They broke apart the powerful Zaibatsu conglomerates, redistributed land to give ordinary citizens ownership, and encouraged industrial growth through low-interest loans. The outcome was stunning. Between 1953 and 1957, Japan's exports of manufactured goods soared by 143%. By comparison, US exports grew by 51% and the UK's 31%, but Japan's true rise had only begun. In 1959, Japan's exports were still dominated by low-cost textiles, mostly sent to unstable Asian markets. Seeing the limitations of this, the Ministry of Trade and Industry introduced a new industrial strategy. The goal: transition to high-tech, high-quality manufacturing and build stronger trade relationships. This marked the dawn of Japan's manufacturing resurgence, backed by foreign investment and a recovering economy. Rebuilding from war, Japan had to reconstruct its entire industrial base. They imported advanced technologies and set up cutting-edge factories. By 1965, the country had a trade surplus, and by 1970, Japan's exports had surged by 380%. Its economy had expanded fivefold, surpassing China, France, the UK, and West Germany to become the fifth largest in the world. Japan continued growing at around 5% annually for nearly 15 years, driven largely by exports. If it was made in Japan, the world wanted it. These new wealth reshaped Japanese lifestyles. By 1978, luxury brands like Louis Vuitton thrived in Tokyo's upscale Ginza district. Hermes followed in 1979, and by the 1980s, brands like Prada had established deep roots in Japan, fueled by high consumer demand. Meanwhile, in the US, manufacturers faced growing struggles. From 1980 to 1985, the dollar surged by nearly 50%, hurting American exports. To fix this, the US, Japan, France, West Germany, and the UK signed the Plaza Accord. It aimed to weaken the US dollar and strengthen other currencies, especially the Japanese yen. Pressured by its allies, Japan agreed. Over the next 3 years, the yen's value almost doubled, going from 239 per dollar to 128. This sharp appreciation made Japanese products more expensive overseas, reducing export demand and slowing economic growth. In response, Japan slashed interest rates to a record low 2.5% and expanded access to credit. This fueled a rapid economic surge. Both citizens and businesses poured money into stock markets and real estate, driven by easy credit. Land prices skyrocketed, spurred by favorable tax laws that allowed everyday investors to avoid capital gains taxes and led to wealthy bypass inheritance taxes. Real estate, especially land, became the ideal investment. Buildings didn't matter, the land itself held the true value. No one cared much about rental income. What truly mattered was the land itself. At the same time, Japan's banking system was in chaos, with very few regulations or oversight. The government encouraged banks to lend endlessly. As a result, banks gave out loans without checking creditworthiness, using inflated investments as collateral. Even as asset prices soared, the Bank of Japan was hesitant to raise interest rates, afraid of slowing down the market. But by May 1989, they had no choice. Rates were increased from 2.5% to 3.25% and later reached 6% by August 1990. This sudden change shocked the market and caused panic. On top of that, the Ministry of Finance placed strict limits on real estate-related loans. Buyers could no longer borrow to continue their speculation, leading to a quick drop in land prices. By the end of 1990, the Nikkei had lost nearly $1 trillion in value and real estate prices had fallen by another $3 trillion. The economic boom was over. The lost decades had begun. After Japan's 1990 crash, the country entered a rare economic crisis. What followed were years of policy mistakes, hesitation, and missed chances, trapping the nation in long-term stagnation. While other countries bounced back from similar crashes, Japan's unique policies created long-lasting problems. By 2024, the economy still struggles with slow growth, deflation, and an aging society. Now, let's break it down. Here are 5 key policy failures that shaped Japan's economy over the past 30 years, and why the situation remains so difficult today. The first issue was the banking crisis. When the bubble burst in the early 90s, banks were overwhelmed with bad loans. Normally, some banks would fail and bad loans would be erased. But instead of dealing with the problem directly, the government allowed banks to keep these non-performing loans. This created zombie banks, banks that were technically bankrupt but kept alive by avoiding reality. For almost 10 years, these zombie banks continued to lend to failing companies, avoiding needed reforms and making the economy weaker. The government acted far too slowly. Though the crisis began in the early 1990s, public money wasn't used to help the banks until 1999. By then, it was too late. Bad loans had grown so large that they made up almost 10% of Japan's GDP. Even after the bailout, banks still supported failing businesses instead of allowing the market to reallocate resources more efficiently. Big banks were on the edge of collapse, which blocked innovation and slowed any hope of recovery. By 2002, non-performing loans were still above $400 billion, stopping real progress. Alongside these banking problems, Japan's fiscal policy also fell short. The government introduced the stimulus package to boost the economy, but they weren't enough. Between 1992 and 1997, only 4.5% of GDP was spent on stimulus. Too little considering the size of the crisis. Worse, many of these efforts were weakened by tax increases or budget cuts elsewhere, so their impact was limited. Then came 1997, just when signs of recovery started to appear. The government increased the consumption tax from 3% to 5%. This decision hurt consumer confidence, causing a sharp drop in spending and pushing the economy back into recession. The outcome was disappointing. In the 1990s, Japan's GDP growth averaged only 1.4% per year, far from enough to fix the damage from the burst bubble. At the same time, the government spent heavily on public works, but most of the money was poorly used. Much of it went to rural infrastructure, which had little effect on real economic growth. These projects often served political goals instead of improving productivity or helping recovery. Meanwhile, cities, where most economic activity happens, got very little funding. The goal was to create jobs and boost the economy, but weak planning turned the spending into waste. By 1995, the Bank of Japan cut interest rates to zero, reaching the end of normal monetary tools. This caused a liquidity trap where cutting rates further had no result. Even with near zero rates, the Bank of Japan had no more room to act. Deflation stayed and prices kept falling through the 90s and into the 2000s. When the bank finally used quantitative easing in 2001, the economy had already suffered from falling prices for more than 10 years. Along with poor monetary policy, Japan's economic stagnation was also caused by its outdated business system known as the Iron Triangle. This close relationship between banks, companies, and regulators kept weak businesses alive with cheap loans instead of letting them improve or close. This system blocked competition and lowered productivity. In the 1990s and 2000s, Japan's productivity growth was only 1.2% per year compared to 2 to 3% in the US and Europe. Japan's large companies were slow, old-fashioned, and unwilling to change, becoming a burden on the economy. Even strong sectors like tech and manufacturing were slow to modernize. Japan's failure to support innovation and allow weak firms to fail led to a business culture stuck in the past and unready for global competition. Thanks for watching. Subscribe to Samga for more content on economics and politics.